Welcome to Stock Talk with Nico Kritikos. Today we're going to be going through Arbor Realty Trust stock. I made a video on this before, but I've had people ask me to make an update on it, so I'm going to do that. And it looks like this is going to be my second video of the day. But if we go to Arbor Realty Trust, we can see that. So I own 125 shares in this account, and that's I think it's about half of my position. I own another 100 shares in my other account. But so Arbor, so I bought my cost basis is $18 a share. Right. And the past year, it's pretty much been hovering around this price of about $18. And I mean, it's gone on a huge run, though. I mean, look at from April 2020, it was $4, and then today it's 17. But so Arbor Realty Trust is a REIT stock, right? They deal with mostly multifamily homes. If we go to their 10K here, we could see 91% of their properties. They have 12.1 billion in assets. 91% is multifamily homes, and they also have single families and more, but the multifamily is the main thing. Then the geographic concentration is mainly in Texas and Florida, which is, I love to see that because we know Texas and Florida is where a lot of people were moving to the past year or two. And so a big chunk of it is in Texas and Florida, but you also have some in New York and Georgia. And then they also have different aspects of their business. One thing I want to point out here real quick is that their CEO and the president, Ivan Kaufman, he has been here for over 35 years. He founded the company in 1983, and he's been CEO and president since 1993. So this guy has a ton of experience, and just thought that was a good thing to point out there. But if we go a little bit back here, we can see that, so total portfolio, 12.2 billion in assets. I mean, so now just think about how much they're, even if they make, 5%, 10% off that. Let's say they have a good year and they make 10%. That's what is that? 120, that's over $120 million, right? $120 million right there. Now, not only that, but if we go to their balance sheet, this company trades at extremely low valuation, a trailing PE of 7, a price to book of 1.4, and a price to sales of 4. If we go to their balance sheet, I think they have 2.5 billion in equity, and this company is trading at a $2.7 billion valuation. That's how cheap this company is. So they have ton of equity on the balance sheet, and they have over $12 billion of assets. So we can see here equity 2.5 billion. Then if we go to the cash flow statement, we can see that operating cash flow is looking strong. It continues to grow. You can see it was negative in prior years. Now it's up to over 200 million. They're investing a ton of money, mostly by financing it, right? $6.7 billion invested in the last year. And then, but end cash position is still growing. It's, more than 2x in the last 4 years, which is good. And then same thing with free cash flow is looking healthy. Of course, since the Fed is going to be raising interest rates this year, that is going to hurt the amount of money they can make and the amount of their margins as well. But because if you look at the data, you can see there are the number of people applying for loans is starting to steadily drop and decline, which is, it's going to pull back on their business a little bit because they've had just a huge run. They did $2.2 of EPS the last year, and they're expected to do $1.80 this year, and then a little bit more, $1.84 next year. So it's not going to be as good as it was in 2021. They're still expected to do 32% revenue growth this year of 337 million, and then 6% growth in 2023. Of course, it's still good to see them growing, but because of the interest rate thing, that is going to hurt their profitability, and less people are applying for loans. But I love the way this company is the way it's positioned right now. And it's not like this company, like yes, the housing market has been hot the last year or two. And yes, that's going to hurt we're not going to see that same amount of growth for a company like this in the next year or two going forward. But it's not like this company trades at some huge valuation. It's not trading at like a price to earnings of 35 or 40 or something. It's trading at a price to earnings of a 7, or, now it's probably going to be like a 10 or a 12. So for how cheap this company is trading, I feel like the downside is limited here, right? And the other thing too is look at the equity on the balance sheet. You're paying $2.7 billion for a company that has 2.5 billion in equity and that owns 12 billion in assets, and that is going to make at least 5% off of that, off of those properties, right? And they're positioned in such a great way with the multifamily properties, and they're in primarily Texas and Florida and New York. Those are the best places to be for in the real estate industry, right? I got to admit, there's one thing that I'm not happy with about this company, the only thing, and that is their share dilution, the number of shares that they keep issuing. And in a way, it's kind of justified. It's kind of makes sense because they claim they'll say, okay, we're using this percentage of the funding to go buy more properties or to buy back other shares, right? And I think they did $1 billion of funding most recently, like a month ago, and they used, I want to say 55 million to buy back other shares, right? But the problem is the bottom line is they're still diluting shareholders, and year over year change is up 23%. So that's not good. Quarter over quarter, it's up 4%. So it's slowing, which is good. It's a good sign. We want it to be like under 1%, right? Ideally, we want them to be buying back more shares than they're issuing, but that's not the case. And for a business like this, where it's so heavily reliant on, financing and raising that money to buy back more properties, maybe it is a good thing because this is a company that could be a fast growing company. They're growing revenues over 30%. So maybe they're going to put this could end up rewarding the shareholder if they put that money to good use and they can get a good return on investment. But if we come down here and we see that the return on invested capital is only 2%, that's not very convincing. So I hope to see some improvement there. The other thing they pointed out here is their return on equity is, let's see, where is it? 19%. So their 19% return on equity is good. That's healthy. And they're saying it's unmatched in their industry. They say that a couple times about what they're doing that differentiates them, which is great. Another positive sign is you can see management team owns 13% of the company. Now that is very good. That's very good. Like compared to the last company I just analyzed, which was Expeditors, they had their management team had less than 1% of the shares. So that's not good. So 13% is strong. But they with all the huge amount of assets they're managing, a $27 billion portfolio of servicing. So the other thing too is there are multiple different product lines, right? They have balance sheet loan origination, right? So they not only are renting out these multifamily properties, but they're also doing loans, and they also have single family rental properties. So I mean, I feel like there's a lot more positives here for the company and a lot more convincing things to see how the company is going to grow than there is a negative. The real negative is just the diluting shareholders, but that can turn to a positive if they are putting that money to good use. The share price is in a good spot. It's kind of been stalling around this $17 mark, so it's not overvalued. What's it called? The valuations are not too expensive. It's in a healthy valuation. And yeah, I like the way they're positioned. I love the dividend. It's 8.5% dividend with only I want to say 60% payout ratio. So I'm very happy. It is hard to find a stock that pays 8% dividends that doesn't have over 100% payout ratio. This company can afford what they're paying out right now. So that is what I like to see. Now, if it starts going over 60% and we get to a 70 or 80, that's when it starts getting more dangerous, because then if they have one bad year of revenue or net income, then that's a risky place to be in, right? But they're growing their equity. They're in a strong position financially. They keep making money. They keep growing. Their properties are in the right place. It seems like they have a good management team. So overall, I'm happy with this company and where they're at. And yeah, if you guys have any questions, comment down below. But thank you for watching, and I will see you in the next video.